Good morning, everyone. This is the appeal of Three Star Market Incorporated, OTA case number 230814196. We are now streaming live on YouTube, but we are not on the record yet. Welcome to the Office of Tax Appeals. My name is Andrew Wong. I'm the lead administrative law judge who will be conducting the oral hearing for this case. On today's panel, in addition to myself, we have Judges Suzanne Brown and Shereen Ridenauer. Also present is our stenographer, Ms. Lynn Alonzo. This hearing is being conducted online electronically, and all participants, including the panelists, are video conferencing into this hearing. This hearing is being live streamed to the public, and a video recording will be made available on OTA's YouTube channel. Also, Ms. Alonzo will report this hearing verbatim and prepare an official hearing transcript, which will be made available on OTA's website. To make a clear record, please speak slowly, clearly, and directly into your microphone or communication device. Do not speak over each other, and please answer verbally using words. And then when you're not speaking, please mute your microphone. Ms. Alonzo, if she cannot hear, understand, or identify someone who is speaking, she has permission to interrupt the oral hearing at any time to get clarification. And I would also like to clarify that this oral hearing is before OTA, which is a separate agency from the California Department of Tax and Fee Administration. OTA is not a court, but an independent appeals body and is staffed by tax experts and is independent of the state's tax agencies. Although I'm the lead panel member for purposes of conducting this oral hearing, my co-panelists and I are co-equal decision makers and may ask questions of either party during the hearing. Further, our three-person panel will decide all issues presented to us, and each of us will have an equal vote in making those decisions. All right, Ms. Alonzo, are we ready to go on the record? All right, thumbs up. All right, let's go on the record. This is the appeal of Three Star Market Incorporated before the Office of Tax Appeals, OTA case number 230814196. Today is Wednesday, April 16th, 2025, and the time is 10:25 a.m. We are holding this hearing online via Zoom. I'm Andrew Wong, the lead panel member for this case, and with me on today's three-person panel are Judges Suzanne Brown and Shereen Ridenauer. Let's do some introductions. Individuals representing the appellant, Three Star Market, please introduce yourselves.
Good morning, Alex Kugelman on behalf of Three Star, and I'm joined by John Stead, CPA.
Thank you. Good morning. Hello. Individuals representing the Respondent Tax Agency, California Department of Tax and Fee Administration, could you please introduce yourselves?
Representative, CDTFA.
Jason Parker, Chief of Headquarters Operations Bureau, CDTFA.
Good morning. This is Christopher Brooks, attorney for CDTFA.
Good morning. Thank you. We are considering one issue today. Just 1 second. All right, well, we're considering one issue today, whether the amount of unreported taxable sales should be reduced. Is that correct, Mr. Kugelman?
That is, yes.
CDTFA, is that correct statement of the issue?
That is correct.
Okay. Let's go over some exhibits. Appellant has identified and submitted proposed exhibits 1 through 5. CDTFA, did you have any objections to the proposed exhibits of appellant?
No objections.
Okay. So appellant's exhibit 1 through 5 will be admitted into the record as evidence. And then Mr. Kugelman, those are the only exhibits you have, is that correct?
Correct.
Okay. And then CDTFA has identified and submitted proposed exhibits A through G as evidence. And then appellant submitted an objection to exhibit D at Bates 52, which is schedule 12A-2H, entitled Weighted Average Markup of Liquor Stores in Oakland. Via email dated yesterday, CDTFA had no objections to removing that page from exhibit D. Is that correct, CDTFA?
This is Jason Parker, that's correct.
Okay. So CDTFA's exhibits A through G, except for page 52 of Exhibit D, will be admitted into the record as evidence. Let's see. Going over witnesses, appellant has identified and proposed one witness. That's Mr. Stead. Is that correct?
Yes.
Okay. And then CDTFA, you have no witnesses. Is that right?
That's correct.
Okay, thank you. In a moment, I will swear in Mr. Stead after we just deal with any, let's see, time allocations. Mr. Kugelman, you've asked for 30 minutes total, and then CDTFA has asked for 20 minutes, and that hasn't changed. Is that right, Mr. Kugelman? About 30 minutes?
I'm sorry about that. I wouldn't even expect it to be 30 minutes.
Okay.
Probably sure.
Okay, you'll have a main presentation, which includes your witness testimony, and then whatever time is left over, you can save for your rebuttal and closing. All right. Any final questions before we swear in Mr. Stead? Mr. Kugelman?
No.
Okay. CDTFA?
Questions?
Okay. Mr. Stead, could you please raise your right hand? You swear or affirm to tell the truth, the whole truth, and nothing but the truth?
I swear.
Okay, great. And just as a reminder, Mr. Stead, you will be subject to CDTFA if they have any questions for you on cross-examination, as well as any panelist questions. Okay? All right. Mr. Kugelman, the floor is yours. You have 30 minutes.
Great. Well, thank you so much. So just a little background on the taxpayer. I would consider it to be kind of a typical corner store, snacks, drinks, alcohol, tobacco. And can I ask actually one question, Judge Wong? Has the panel reviewed any of the exhibits yet, or any of the background, or is everything basically de novo here being presented?
We have reviewed the record.
Okay, you have reviewed the record. Okay, I don't want to waste time going over things that would probably be fairly obvious.
Yep.
Well, thank you. So kind of the issue here, and we're kind of on a call with a number of tax professionals, and especially with the idea of tax controversy and compliance, and the idea that a taxpayer must substantiate the items that it reports is kind of, I think, the foundation of all tax controversy and compliance, right? And because taxpayers don't always keep good records, tax agencies, including the department, have the ability to say, unfortunately, the substantiation is not sufficient. So we're going to have to do our own analysis and make our own estimation. So I'm going to point first just to Exhibit A, page stamp page 8. And essentially in the department's appeal decision, I'll read it. If a taxpayer's records are insufficient or are proven unreliable, it is appropriate for the department to compute and estimate that taxpayer's liability by alternative means. Now, looking at page 10 of Exhibit A, and this is towards this line 10 on that document, on the decision. When it is determined that a taxpayer's records are such that sales cannot be verified by direct audit approach, or reliance cannot be placed on those records, the department must calculate the sales from whatever information is available using indirect audit methods to determine the correct tax liability. Okay, so this is kind of goes to the core of the issue regarding inventory. So the taxpayer did not have good substantiation, did not have good books. There was a vendor survey that was conducted, and that vendor survey is essentially the evidentiary foundation for the increased sales tax liability. Now, looking at the department's own manual, and this is Taxpayer Exhibit 5 at Bates 55, common problems with records. Our auditor may be able to obtain enough information from the available records. If not, you may be required to reconstruct the missing records, or our auditor may need to estimate the missing information. And so from our perspective, the inventory is missing information here as part of the entire set of events purchases, sales, inventory. So the two primary arguments that we have regarding this is going to be, one, there should have been an allowance for increased inventory. No change to inventory is inconsistent with the record and the work papers themselves, certain adjustments in the work papers. The second issue is essentially that we believe that the weighted markup is skewed, and both of these, I think, relate to the specific audit period and the fact that COVID is right in the middle of this audit period. Okay, let me go through this. So the audit period, as I understand it, was 2018 quarter one through 2021 quarter two, I believe. The lockdown order was March of 2020. Now, I think it kind of goes kind of without saying, we all understand that life changed dramatically with that lockdown order. And that lockdown order was not 2 weeks, that lockdown order was months in reality, right? Which meant that everyone's habits had to change. Now, this meant staying home. There really weren't restaurants or bars to go to. And now people were consuming essentially more items at home, buying more from stores, but specifically alcohol being a primarily affected item. Consequently, the product mix at 3-Star changes in this time period due to COVID, okay? And as we all experienced, there was inflation in retail prices, okay? So let's get first to the idea that COVID changed the habits. And this is evidenced by the purchases themselves. So I would like to go through a few of the pages in the work papers. This is Department Exhibit D. And let me just start with Bates 55. This is the Young's Market vendor survey. And if you look at this, and let me ask, if I'm going too quickly, I can pause to allow people to get to the page. Okay. So if you look here, you can kind of see the increasing purchases just generally. But when you get into 2020, and especially second quarter of 20, you have basically a 50% jump there, maybe a little under 50%. And then third quarter 20 more increased, and fourth quarter 20, first quarter 21 are two of the biggest periods on, for those purchases compared to the 18 and 19 purchases. If we go to, and I may have had the wrong Bates stamp. 55 is Southern Glazers. I'm not sure, maybe 55 or 56. So the Southern Glazers vendor survey. And if you can't find it, let me know, I'll find it. Sorry, this would have been 55. The Young was page 54. So if we look at Southern Glazers vendor survey, we see the same trend, but you can see that second quarter of 20 is an enormous jump from 121,000 of this netted purchases to 292, right? And I just want to pause here for a moment and just, if we were looking at periods that were, let's say this was 17, 18, 19, okay? And the purchases were relatively flat or consistent, I would not be arguing a change of inventory, okay? But we have essentially a black swan event that has changed the world as we know it, right? Which means that this store is purchasing more. It has to have more in the store because there are more purchases happening. And it's reasonable to assume that there were more sales tax. It is not reasonable to assume that there was no change to inventory. Okay, and if we take a look a little bit further down, we can take a look, and I'm sorry, before I got to that, if you go to Bates stamp page 58, this is the Pepsi purchase. You can see that the second quarter of 20, there's actually a decrease. And people aren't sitting at home drinking Pepsis, are they, right? They're sitting at home having a glass of wine or a beer or something along those lines, right? So we can see this fundamental change in what people are buying, right? And that affects what the store is doing post-COVID versus pre-COVID, okay? Now, let me see. And all this information is consolidated on base stamp, I believe 53, which is audited taxable purchases 12B. We can see all of these vendor surveys consolidated. If we look at column U, you can see just the material differences between the 2018 totals, the 2019 totals, and now the 2020 totals. And I realized I may have misspoke when I said second quarter of 21, maybe the audit period ends first quarter of 21. So obviously a unique circumstance, but that's something that should have been considered by the auditor that I don't believe was. Now, I do think that there are at a minimum implied changes to inventory within the work papers themselves. So I would ask that we go to page 12A1, which I don't have the base stamp. Let's see if I can find that. 12A1 is base stamp 37. I'll give everybody a moment to get to that. So on this 12A, on this percentage of error calculation, lines 13 and 15 are pilferage and self-consumption. And if you look at columns D, E, and F, you see those numbers rising. Now, these have been excluded from taxable sales. Now, obviously, I think obviously, the pilferage and self-consumption is taken from where? The existing inventory. You can only reach this conclusion if you're saying there's been an inventory has increased by approximately 50% from 2018 to 2020. Okay. Now, there's an inherent problem here too, which is that the taxpayer, by carrying more inventory, likely has sold that merchandise in a later period and paid tax on it. So essentially, there's a concern that there could be double taxation of this. Okay. So from my perspective, from the taxpayer's perspective, this increase only relates to the inventory that is there. There is a 0% adjustment to inventory. Now, from the time that we were working with exam or audit and working with, trying to resolve the matter with settlement and appeals, it was frequently repeated by the auditor herself, who did participate in the appeals, that the inventory was not substantiated. And again, I'll go back to this, the very beginning of kind of my remarks. If this was a case where the sales, there was $1 million, as an example, $1 million of sales was reported, and let's say the taxpayer reported that 50% were non-taxable, and the auditor had said, well, please provide me invoices and other substantiation that you had those sales were non-taxable, and the taxpayer did not provide that, and then all of the sales were deemed to be taxable, that would be totally reasonable and rational, because that was based on the failure to substantiate. But there was an initial determination the taxpayer could not substantiate anything. So the idea that using the vendor survey, this indirect method, an implied sales method, reasonable. But if you're going to do that, there needs to be an accounting for both, not only the credits, but the debits as well, right? And this material change, which were reflected in these records, are, I can't think, demonstrate that it seems inherently unreasonable to think someone who increases their purchases by factors of 100% in these periods would not actually carry more inventory at those times. Now, the second argument that we kind of have is more related to the weighted markup. So I'm going to ask John Stead to step in and maybe talk a little bit maybe about his work papers on the inventory, and then to talk about the weighted markup.
Hello. I can address the inventory first. In my work, working with small businesses, doing their accounting, whenever a business needs to expand to increase their sales, if they're selling product, they also have to increase their storage capacity to hold all of the product. So you can imagine a liquor store selling $1.2 million every year in alcohol, and then one year they're going to sell 1.5 of their usual. They need more storage if their storage isn't absolutely full. So the inventory ordinarily in real life practice on the street ends up being a bit of a function of time. And so when a purchaser at the store says, okay, I need to buy Jack Daniels and I need to buy Bullet Bourbon, they ask themselves, how many days worth of Jack Daniels do I have on hand? How many days worth of Bullet Bourbon do I have on hand? And they make their purchases from their vendors accordingly. Because they are selling more, they need to have more in the back room ready to put back on the shelves. And so it is an ordinary assumption that inventory increases in the back storage area if you are selling more out of the same store. I worked with the taxpayers themselves. If you look at the taxpayer exhibits, Bates stamp 43, that's 43. The way that they took inventory is they had a professional service come and do the inventory for them. These guys weren't saying, okay, Wonder Bread, white, loaf, times 6. Wonder Bread, wheat, loaf, times 7. Bullet Bourbon, 8 bottles. They had a professional service come in and make an estimate. It's not exact. But what you can see is that in 2018, 2019, and 2020, that first part of 2020, okay, 500,000, 469,000. Then there's a little jump, 786,000. And then you can see January 1st, 2021, only 566,000. And then they had the professional people come back in February of 2022 and said, guys, you missed our inventory. We had a storage room. And then when they counted that, they showed 900,000. Big jump from 2018 and 2019. I don't presume that these are perfect inventories. Of course not. If it was perfect, they would be itemized every little item. But what it shows me is that when they took the inventory in February of 2022, they showed a much higher inventory. And even if it is imperfect, it shows the trend. And we can all consider, just from common sense, if they're selling more, they have to have more storage just in the back room to put the stuff on the shelves the next morning. When I look at the CDTFA exhibit, Exhibit D, Bates stamp 37, which is the one Alex was just referring to, they can't have sold every single item that they purchased from the vendors. There has to be a lag, because when the vendor delivers, you don't sell it all immediately. And if you are selling the items and then buying more items, there's a slight lag. And so it would be fair to say that the variance in their carrying inventory should be applied as a one-time discount to say they must not have sold the difference in their inventory in that audit period. They sell it in the next one. And so there should be an inventory discount. The other item that I noticed is on that same exhibit, CDTFA Exhibit D, Bates stamp 37, line 19, the weighted average markup is uniform across the board. And the weighted average markup comes from a shelf test where an auditor actually went with the taxpayer marking down prices in the store, but they did it in June of 2021. And in June of 2021, the prices were much higher per item than those same items in 2018 and 2019, specifically because the demand of the whole world changed, but the demand of a corner store selling alcohol in Oakland changed. And we know that from our own lives. We know that people's habits changed. And we also know that inflation is not a perfectly uniform item. If it was, nobody would care about the price of eggs because their wages would have increased commensurately. And then inflation wouldn't really have an effect on the end user. What happened starting in the second quarter of 2020 is that the prices of the corner store changed because the demand changed. And so the shelf test is undoubtedly correct, but it's correct for June of 2021. And those prices, I don't believe, on that shelf test are reflective of what must have been charged in 2018 and 2019, because the consumer base that actually walks into the store and buys things had different habits. And so to apply a June 2021 markup to 2018 and 2019 ignores the change that occurred in the world during the audit period. Alex, have I answered your questions? Okay.
John, can I ask you one other question?
Go ahead.
Is there a specific sheet within your analysis regarding the weighted markup and how you computed a different?
Yes. So if we look at the
John, hold on one second. You
okay.
might want to just present the page that you're looking at, if that's allowable with the panel.
I'm happy to share a screen. Okay, this is the screen with all the exhibits. Here is the taxpayer exhibit. So this is taxpayer exhibit, Bait Stamp 30. What I did with the taxpayer is I went through the purchase logs, because the purchase logs are obviously the most correct thing we can have. They come directly from the vendors. But I asked the guys at the store, hey, how much do you mark up AB sales? And they said, 29%, somewhere around there, John. And I said, how much do you mark up Acme bread? And they said, we mark that up 10%. We don't make any money on that. And we went through each of the items. And this was just working with the taxpayer to ask, okay, what's your general markup? And the reason I did that was not because I doubt the shelf test, but it was because the taxpayers' actual habits are going to be reflective of a broader picture in time and is going to be colored in by the fact that they were operating in 2018 and 2019 before COVID. And so I wanted to look at what the real sales would have been if we were to trust the taxpayer on their markup, because they're in the store every day actually putting stickers on loaves of bread and stickers on bottles of alcohol.
Sorry, Mr. Stead, sorry, if I could interrupt just one
Yes,
second.
sir.
We're not we're not sharing, or you're not sharing your screen at the moment. So is there a specific page number in the
Oh, I'm terribly
exhibits?
sorry. My screen tells me you're screen sharing. I'm looking at taxpayer exhibit Bait Stamp 30. And that's page 34 of the PDF.
Okay, and so at the top it says vendor AB sales is the first line.
Yes,
Oh,
sir.
Sorry,
Mr. Stead, I'm sorry, Judge Wong. You are sharing on my end. However, please note any confidential information you're showing on the screen is publicly available live stream. We do have the exhibits available on our own screen. Should you just want to continue to refer to the Bait Stamp and direct us to your attention to a certain thing, as opposed to screen sharing, it's up to you and your client. However, please be aware this is live streamed to the public.
Thank you, Judge Ridenhour. Alex, what are your thoughts?
If you want to pull it down and just, I think now everybody's on the same page.
Okay, I will stop sharing. So looking at the taxpayer exhibit, looking at the average markup column, that's not the average markup that would be reflected by the shelf test. The shelf test shows a picture in time of June 2021, and in my view, that's a different markup than what should be expected in 2018 and 2019. And so when I did the analysis with the taxpayer, I asked him, okay, we know there's a shelf test. What do you mark up this stuff at? Because the taxpayer is going to have a different idea because it's going to be colored in by those earlier periods. Alex, have I answered the question you were asking?
I think so. And the only last comment I make, because I know we're getting to our 30 minutes here, which I did not think we would do, which is that the weighted markup is when you go through the tab, and I forget the tab number on the work papers. When you go through the weighted markup, a huge chunk of that is the alcohol sales, right? And I think as demonstrated by, looking at the vendor survey and specifically some of the alcohol vendors, there was a much heavier, the amount of alcohol sales were, as a percentage, were much larger in those periods, the post-COVID periods. And this weighted markup percentage of 29.38 is based off what people's habits in that time, as opposed to what was reality in 18 and 19, which is that there would have been a decrease to alcohol and an increase to other items. And I think, and John, if you have any comments there, go ahead.
Yeah, the summary of my analysis is that the weighted average markup on CDTFA exhibit Bait Stamp 37 is uniform across 3 ununiform periods. And the onset of the lockdown and the pandemic increased the prices. And so a shelf test conducted in 2021 does not faithfully show the markup that would have been in place in 2018 and 2019. So I think the weighted average markup for 2018 and 2019 should be lower than 29.38. And then additionally, there's a missing line between line 11 and 13 on that sheet. That's CDTFA Exhibit D, Bait Stamp 37, because there is no allowance for a greater inventory carrying. And so there should be a greater inventory, which was not sold in that period, but was purchased in that period. And so there should be an allowance for the difference in inventory applied in the audit period. Those are the 2 items that I think should be considered and are relevant.
Mr. Kugelman, you have 3 more minutes. Did you have any other?
Not at this time. I think that's a good summation.
Okay, great. Thank you. I'll now turn it over to CDTFA for any questions on cross-examination they have for Mr. Stead.
No questions.
No questions. Okay, thank you. And then now I will turn to my co-panelists to see if they have any questions for either Mr. Stead or Mr. Kugelman, beginning with Judge Ridenhour.
No questions at this time. Thank you.
Thank you. Judge Brown?
Yes, let me start with one question. I think this goes to Mr. Kugelman. I wanted to ask about a letter that my office sent, that Judge Wong sent, called an additional briefing order in August of 2024 that asked whether appellant would provide any documentation that substantiates the beginning and ending inventory figures for 2018, 2019, and 2020 that Mr. Stead relied upon and incorporated in appellant's beginning and ending inventories for those years. Am I correct that appellant did not respond?
You are. So I apologize. So I had an associate attorney who had filed this and set up the OTA account. So I was unaware that that was even issued, and I really wasn't even aware until I'd gotten an email maybe about 6 weeks ago regarding the pre-hearing statement. I believe, now maybe we did, or I believe, because again, I came into the audit later, but the reports, the inventory reports that John said was referring to, we do have those, and I thought that those were provided earlier. Now, perhaps they weren't, but we can provide those at this time.
So let me just confirm, there's nothing in the exhibits now that is responsive to this. There's nothing you want to point us to right now. That we have in the record. You're talking about something that's not in the record.
Yeah, maybe in the department's record going back, but I can review it while the presentation's going on and make sure, but nothing that we added into our exhibits.
Okay, thank you. That's all I have for right now.
Thank you, Judge Brown. I did have a couple of follow-up questions with regards to Mr. Stead's testimony. Mr. Stead, are you there?
Yes, sir, I'm here.
Okay, so you had referenced that there was an inventory service that appellant had used about circa 2022, and then that it had missed a storage room. Could you talk about that a little bit more?
So the guys at the store, they have a little storage room where they put the boxes of bourbon, vodka, etc. And their professional inventory service people were not very good. And so when they came in and did an inventory, they missed the storage room because it's not the same guy every year coming through to mark the inventory. And so they had to call them back. And then when they computed the inventory that was actually in the storage room, the estimate was somewhere in the neighborhood of $400,000 worth of alcohol still in cases, still in boxes, still marked, bullet bourbon, but just jammed into a storage room stacked up to the ceiling. The inventory service was not very good. This wasn't a strict, very well executed inventory that would make an accountant pleased and proud. This was a professional service that made estimates based on size of the store, the product mix, and what they see on the shelves. But what I noticed when I looked at this imperfect inventory was, when they came back and actually added the storeroom, gosh, that was a big difference in value. And that's when Alex and I were talking and asking, could they have possibly sold all of that in the period? Because the CDTFA exhibits presume every single item that was purchased during the audit period was sold during the audit period. And we thought it can't be, because they were purchasing so much more, they had to have stored some, even if it was sold 4 days later. The carrying inventory had to have increased. Am I answering the question you were asking, Judge?
Yes, at the beginning you did. And then
Okay.
I do have a follow-up question regarding,
Yes.
You had mentioned that there should have been an inventory discount. In your opinion, what should that discount have been? That's the first part. The second part, and can you substantiate whatever figure you're going to tell us or percentage?
I think that the inventory discount should be a percentage, not a dollar number, in the same way that pilferage is a percentage and not a dollar number. And I think that the inventory discount should be the cost of the inventory that represents the difference in the purchases. And so if the purchases in 2019 are 1,391,000 and the purchases in 2020 are 1,893,000, the difference between those should be held as an inventory difference, and then there should be a percentage applied as a discount.
Okay. And in this particular case, are there any, so off the top of, based on your analysis, do you have a specific number as far as the reduction?
I don't have a hard number, but I do know with the markup of 30%, I would say a difference of 500,000 times 30% should be at the minimum inventory holdback.
All right. Thank you very much. I had no further questions at this time. So I will now turn it over to CDTFA for their presentation. You have 20 minutes. Thank you.
Owens Corporation, operating a liquor store in Oakland, California. Reported exemptions include non-taxable food products and sales tax. Exhibit D, page 32. Audit period is from January 1st, 2018 through June 30th, 2021. Items reviewed include federal income tax returns for 2018, 2019, and 2020. Profit and loss statements for the first and second quarters of 2020. Cash register tapes for the second quarter of 2020. Purchase invoices for the first and second quarters of 2020, as well as for June and July of 2021. And bank statements for various periods. Vendor purchase reports for the audit period were also obtained. A purchase segregation was conducted for the second quarter of 2020, and a taxable percentage of purchases was computed. Exhibit D, pages 69 to 73. Using the taxable percentage computed from the purchase segregation and applying it to the federal income tax returns, recorded purchases revealed taxable purchases were more than taxable sales, with an overall negative markup of 10%. Exhibit D, page 82. Markup for reported non-taxable sales was 250% when compared to non-taxable purchases. Exhibit D, page 82. Based on the markup analysis, reported taxable sales were impeached, and an alternative method, markup of purchases, was used to determine taxable sales. During the purchase segregation, the auditor noted purchase invoices provided were incomplete. Therefore, the auditor contacted known taxable vendors to obtain appellant's purchases for the audit period. Exhibit D, page 68. Based on the purchase information supplied by the vendors, Exhibit G, pages 167 through 558, taxable purchases were obtained for the period from 2018 through 2020. Exhibit D, pages 53 through 67. Shelf tests were conducted to establish markups on beer, wine, alcohol, cigarettes, tobacco products, carbonated drinks, sundry items, and periodicals. Exhibit D, pages 39 through 51. Markups for various categories were applied to the percentage of purchases per the purchase segregation to compute a taxable weighted markup of 29.38%. Exhibit D, page 38. Audited taxable purchases for the period from January 1st, 2018 through December 1st, 2020 were reduced by 1% for self-consumption and 1% for pilferage to establish audited cost of goods sold of around $4.4 million. The weighted taxable markup factor was applied to taxable purchases to compute audited taxable sales of more than $5.7 million for the period. Exhibit D, page 37. Audited taxable sales were compared to reported taxable sales of just under $2 million for the same period, and percentages of error were computed. Exhibit D, page 37. Percentage of errors were applied to reported taxable sales for the entire audit period to determine unreported taxable sales of almost $4.7 million. Exhibit D, page 36. It should be noted that taxable purchases reflected in the vendor survey totaled more than $4.5 million for the period from 2018 through 2020. This is $2 million more than the federal income tax returns recorded purchases for the 2018 through 2020 period of just under 2.5 million. Exhibit D, page 82. The $4.5 million in taxable purchases is also $2.5 million more than reported taxable sales of around $2 million. Exhibit D, page 37. The markup on purchases was fair and reasonable method to determine appellant's taxable sales. The department used third-party records of appellant's purchases and a shell test to establish a 29.38% markup. Appellant now has the burden of proof to show the department's determination is incorrect. Appellant claims it had to increase inventory due to COVID. This claim is not supported by any reliable evidence. During the years 2018, 2019, and 2020, appellant did not have a third party conduct an inventory account. Further, the recorded inventory amounts stated in the federal income tax returns have been deemed unreliable because of the office discussion held on January 18, 2022. The taxpayer's contentions section states, the representative stated that taxpayer carries a lot of unsold inventory, and the inventory listed on the federal income tax returns for 2018, 2019, and 2020 are not correct. Taxpayer is in the process of hiring an independent person to perform a physical inventory count of the store merchandise. Exhibit D, page 26. Since appellant did not provide any inventory reconciliation worksheets supported by third-party inventory documents, the department could not verify the beginning and ending inventories for any of those periods. Review of the appellant's worksheets concerning purchases and inventory valuations shows the taxable purchases amounts are $633,000 less than the actual amounts per the vendor surveys for the period from January 1st, 2018 through December 31st, 2020. This can be viewed on Exhibit D, page 53, which is what the department has, versus the appellant's purchase numbers listed on pages 156, Exhibit F, 156, 159, and 162. Appellant, the department's purchases are $4.4 million. The appellant's representatives' purchases are $3.8 million. No explanations are given as to why the difference. Appellant claims to have revised inventory amounts. This is on Exhibit F, page 166. As previously stated, the appellant's representative had already stated that physical inventories were not taken during the 2018 through 2020 periods. In addition, appellant's worksheets do not show how the inventory amounts are derived, and no explanation as to why updated inventory amounts differ from the federal income tax returns inventory amounts. That is on pages for the differences on the federal income tax returns, or the income tax return comparison is on Exhibit D, page 85. Taxpayer representatives, the inventory figures again are on Exhibit F, page 166. In addition, appellant has not stated how they funded the buildup of their inventory. It does not appear appellant would have the funds available to support a buildup of inventory in excess of $675,000 from January 1st, 2018 through December 31st, 2021. When the appellant does their markup on, or does their sales and computed markups in their own worksheets on Exhibit F, page 162, the markup does not account for the inventory going down in 2020, which is contrary to what the appellant's argument was today. The appellant's inventory actually goes down to $566,265,000. at the beginning of 2021, which is the end of 2020. This is a difference of $219,809 from what the appellant shows on page 162 when they compute their markups of 25%. If this was taken into account, the markup or the gross profit would be reduced to $287,343. The cost of goods sold would be $2,235,948. And the markup, which the appellant had said was steadily at 25%, would drop to 12.85%. This was not accounted for in the appellant's own working papers. In addition, the appellant's markup of sales, or appellant's average markups on their analysis, has no support to verify how the markups were derived. He simply asked the taxpayer what it was. There's already documentation on Exhibit D, page 85. This is on the cross notes or assignment activity report on July 28, 2021. And taxpayer is still confused about how we calculate the markup and would like further explanation. I ought to repeat it again that the way we calculate, meaning the department, the markup is different than how the taxpayer calculates it. Basically, it sounds like, and this happens many times based on our history, based on the department's history with computing markups, is that markup is derived on gross profit divided by cost versus what's called a gross margin ratio, which is the profit divided by the sales, which is going to give a lower number. So the derived 25% that the appellant has seems more of a gross margin, but the 25% margin equates to a 33% markup because you're using a different base. Also, auditor did request beginning inventory numbers on several occasions. July 1st, 2021. Again, this is using the cross notes or the assignment activity report, Exhibit D, page 87. September 29th, 2021. Auditor requests inventory amounts, Exhibit D, page 89. October 13th, 2021. Auditor and supervisor again asked for inventory amounts, Exhibit D, page 90. And January 18, 2022, taxpayer is still trying to get independent inventory count, Exhibit D, page 91. I believe that is the end of my presentation. I'm available to answer any questions you may have.
Thank you. I'll now turn to my co-panelists for any questions they might have for CDTFA, beginning with Judge Ridenhour.
No questions, thank you.
Thank you. Judge Brown, any questions for CDTFA?
One minute. I suppose I did want to ask whether I don't know in CDTFA's presentation whether you, Mr. Suazo, whether you covered the concept of inventory discount. I might have missed it, but that appellant's witness was arguing for an inventory discount. Can you address, if you haven't already, or just remind me what, if you have, what CDTFA's position on that is?
Sorry, we have no ending inventory. It's already, the taxpayer at the time of the conference has already said that the inventory numbers are incorrect. Based on appellant's representative, he also says that they could be incorrect. He says that the inventory people who did the inventory count, if there was an inventory count, were not the best. And it was all based on, and it's based on some sort of evidence, which he also says they missed the room. However, we don't know if they missed the room in 2018, if they even did an inventory count, 2019, if they did an inventory count, 2020, if they did an inventory count. We don't know if the room was missed all the whole time. So based on our evaluation, there is no inventory to make an adjustment for, because many times inventory can go either way. You can either increase it or decrease it. In 2020, if you look at it, the beginning of 2021, which is the end of 2020, the increase actually goes down. The inventory goes down. The taxpayer representative's inventory, he starts with 500,000, and then he ends with 469 at the end of 2018. 2019, he starts at 469, and then he goes up to 786,000. In 2020, he starts at 786,000, and then he goes down at the end of the year or beginning of 2021 to 566,000, which is contrary to his argument of a buildup. And then in 2021, when the audit period's already ended, 6 months, or he says he did it in February of 2022, the inventory amazingly goes up to 956,000, which is basically a $400,000 increase in 1 year, based on their own based on his own records on page 166. And now again, the inventories on the federal income tax returns are different than what the taxpayer representative or the appellant's representative had in 2018. This is on Exhibit D, page 85. Beginning inventory is at 602, so it's a $100,000 difference from the beginning inventory of the appellant's representative. The 2019 beginning inventory is at 640 versus the appellant's representatives at 469. This is in thousands. And then in 2020, the beginning inventory is at 825,000 versus the appellant's 786. Now, the ending inventory in 2020 on the federal income tax return shows 742, and the ending inventory or beginning inventory in 2021 shows 566,000. So it's all over the place.
Thank you. I don't think I have any further questions right now.
Thank you. And so, Mr. Suazo, I just wanted to follow up on your, excuse me, just a second. Apologies for that. So regards to the markup, your analysis of appellant's CPA's analysis is that they weren't actually using a markup in the way that CDTFA has calculated it, but they're doing it based on a margin. Could you just recap that for me?
I don't know if they're doing it on a margin. I'm just saying, if you look at the entry by the auditor on the assignment activity reports on July 28, 2021.
And what page was that? That was
page 88. Says taxpayers, are you there yet?
I'm there, yes.
Okay, so if you go into the middle of it, it starts, taxpayers still confused about how we calculate the markup and would like further explanation. I ought to repeat it again, that the way we calculate the markup is different than how the taxpayer calculates it. Many people with grocery stores, liquor stores, cash businesses, they calculate items on a gross margin, which is the profit divided by the sales, which is going to give a lower percentage because you have a higher base than the markup, which is the gross profit divided by the cost. IRS usually uses a gross margin. CDTFA uses a markup on items. The other thing is the appellant just used, or the appellant's consultant, when they're doing a markup, they're just getting something off the top of the head of the owner or the taxpayer or the appellant, versus what we did was we went line by line to check the validity of each item, and we weighted it.
Got it. Thank you very much.
Okay.
All right. I'll now turn it back over to Mr. Kugelman for your rebuttal and closing. You have about 3 minutes.
Judge Wong, I wanted to ask, if you might, I do have a couple comments as rebuttal. You would ask a question of John Stead regarding an analysis, actual calculation of inventory. There is actually a page in his analysis that does address the question you asked last to him. Would it be possible if he came on for a minute just to direct you to that page?
Sure.
John, if you don't mind doing that.
So it, of course, in taxpayer exhibit Bates stamp 43, this was the inventory that the taxpayer gave to me and said, we had these experts come in on these days and do an inventory. This is how they did it. And so if you look on the left, January 1st, 2018, the way that their service did the inventory is they said, taxable looks like you can sell 29,561. Non-taxable looks like you can sell 25,448, and down the line. And then what I did is I said, okay, well, based on their markup, that would mean that the cost was, and then that's column 4, cost of the inventory. I'm not under the impression that the people that they hired to do the inventory did an amazing job. I'm not under the impression that these are perfect inventories. The thing that struck me the most was all the way on the right, when they had a January 1st, 2021 inventory, and then they had a February 6, 2022 inventory. The big difference, which the CDTFA representative noted, this remarkable difference of $400,000 worth of inventory. What had happened on that day, and the taxpayer told me, he said, oh, this was the day when I told the representative, hey, you've been missing this room. And then he went into the back room and looked at the storage. Alex, have I answered the question that you were asking?
I think so. Okay. So let me just go through and quickly just kind of respond to a few points raised. So the first thing, as far as the date, as far as the taxpayer's misunderstanding of a weighted markup, I agree that in July of 21, that conversation was logged and probably happened. We were not involved. The analysis that was provided today came months or years after. Okay, so the taxpayer's individual understanding is totally irrelevant. In fact, if I can ask, what page was that note on?
That's CDTFA Bates stamp 88.
I would note if you look through that log as well, there's a number of entries about the auditor emailing spreadsheets in which the taxpayer was providing the percentages. And so to the extent that the CDTFA is saying it's unreliable to rely on the taxpayer's representations regarding markups, I think what's good for the goose is good for the gander, right? And you can go through the notes there and see that right in there. If you go back up to another point, I think overall, you kind of get a whipsaw argument here from the department. The federal income tax returns are unreliable, hence it's reasonable to do a vendor survey. I agree with that. Yet there's this whipsaw argument that the inventories on the tax return somehow are accurate or somehow contradicting the argument. I think the reality is those returns, including probably the sales tax returns, are just wholly incorrect, right? And that's the purpose of the difference between substantiation versus estimation. If this was an income tax case where a taxpayer was purchasing had cost of goods sold, had bank deposit analysis, a reasonable analysis would not say every dollar that went in was taxable income. A reasonable analysis would offset for the allowable purchases. The last thing I will comment on, I did not realize that the inventory reports were not provided. So I am happy to provide those now And I know that's an issue. I didn't even realize that was part of John Stead's analysis. I'm happy to provide those now if that is going to be relevant here to substantiating. However, from the taxpayer's position, it's not an issue of substantiation. It's an issue of estimation and, allowing for both credits and debits.
Is that it, Mr. Kugelman?
Yeah, I think so. I think
Okay.
the reality is that that's kind of the summation.
Okay. Your time is in fact up. So I will now finally turn it over to my co-panelists to see if they have any final questions for either side, beginning with Judge Ridenhour.
No questions. Thank you, everybody.
Thank you. Judge Brown?
No questions, thank you.
Okay. I also did not have any questions. However, Mr. Kugelman, you'd indicate, oh, sorry. Mr. Suazo, yes.
I just want to clarify something on the spreadsheets. That's the appellant provided the prices, not the percentages
Okay,
for the shelf test.
Okay, got it. Thank you so much. All right. So, Mr. Kugelman, you'd indicated your willingness to provide the inventory. How long would you take you to provide those?
I can email them right now, download them and send them to Mr. Rios.
Okay. All right, we'll leave the record open and allow you to do that. And then I will give CDTFA 2 weeks to take a look at those and provide a response. Is that sufficient, CDTFA?
That should be fine.
Okay. So we will leave the record open and I will issue an order for that. But Mr. Kugelman, if you can submit those as soon as possible, that'd be great. And then CDTFA will have 2 weeks to provide a response, and then we will close the hearing, or sorry, the record at that time. All right. This concludes the hearing. We're leaving the record open. And so after the additional submission period is over, the panel will meet and decide the case based on the exhibits presented and admitted as evidence, as well as the witness's testimony. And then we will send both parties our written decision no later from 100 days from that date, which is not 100 days from today. Okay, I want to thank both sides for their time, their presentations, the witness as well. The oral hearing in this case is now adjourned. Oral hearings will recommence this afternoon at 1 p.m.